I'm going to do an additional video to the weekend report. And now that I've become more or less convinced that we probably are not going to transition into a parabolic move, um, in a final 4-year cycle top sometime in the next 3 or 4 months, I now want to look at the how far we are stretched above the mean. I want to kind of analyze this in terms of when I expect the next 4-year cycle low, um, and look at some past precedents. So first off, I've got the Dow on here, and the two leading indexes have been the Dow and the Nasdaq. And so I'll start off with uh, as I'm going to use the 200-week moving average as the long-term mean. That average seems to be the magnet that, more often than not, when a 4-year cycle um, decline terminates, if we're in a secular bull market anyway, it seems to, at least come back down to tag that long-term moving average, that long-term mean. And so, as you know, I've modified my thinking and to uh, use the 2011 pullback as a short 4-year cycle low. Uh, that was triggered by the long 7-year cycle ahead of it. Um, you can see we came back to tag this that 200-week moving average. The next 4-year cycle low in 2016 again tagged the 200-week moving average. We did it in 82, we did it in 87, again in 90, and very close in 94. The one that really didn't make it all the way back was the 98. So at our recent top, we were the market was stretched. The Dow anyway was stretched about 41% above this 200-week moving average, and that's fairly extreme. It's not as extreme as it has gotten in the past, and I'll show you here in a minute. The Nasdaq just a little bit more extreme at 43%. Okay, here's the chart of the Nasdaq. A little bit more extreme, like I said. Now, I want to try and look at this in the context of the next 4-year cycle low, which is going to be due in 2020. And as many of you know, these cycles, they can either right translate or they can left translate. If we're in a secular bull market, they almost always right translate, and you can see that is what is happening here. This 4-year cycle, right translated. Again, right translation here into the 2016 multi-year cycle low. We rallied, about 3.5 years, and then spent about 6 months going down. During this, we rallied a little over 2 years, and then like 3 or 4 months going down. I expect that we're going to get the same thing here. We're going to have probably a fairly strongly right translated cycle. Now, the characteristic with these right translated cycles is that when they do top, they tend to, since they don't have a lot of time to move down into the cycle low, they tend to occur as very often as some kind of a crash type event over a very short period of time. The gold standard, so to speak, for an extremely right translated cycle that exhibits this crash type event is, of course, the 1987 cycle. Let me change this to a log scale. So here's the 87 uh, multi-year cycle bottomed in 82. You can see we rallied very strongly into the very tail end of a 4-year cycle that was already stretched. It went 5 years instead of 4, and then the market just didn't have a whole lot of time to do what it needed to do, and so it did it in the form of a crash that brought the market back down to this 200-week moving average. I suspect we're going to get something very similar when we get our next 4-year cycle low in 2020. So I want to examine this 1987 4-year cycle a little bit, since I kind of think we may follow a very similar scenario as what happened back then. At this top, this was the top of the 4-year cycle. The Dow, which was the leading index at the time, stretched about 71% above this 200-week moving average. And as I pointed out, in our current market, we're about 43%, or were 43% at the recent high in early February, late January. So we're not, at an extreme that would demand that we have to immediately make a trip back down to the 200-week moving average. And that makes sense, since the 4-year cycle low is potentially still about 2 years away. But it's probably, as we've seen, we're just wasting too many weeks in this intermediate cycle already. So it's likely that we're going to chop around and consolidate, maybe something similar to what happened in 86. At these peaks in 1986, the Dow was about 46% above the 200-week moving average. So, very similar to where we're at or where we were at the top back in late January of this year, of 2018. And we may end up with some kind of a very similar year as 86, where we just kind of churn sideways and give this moving average some time to catch up to price a little bit, and then we get our next move up to complete this the multi-year cycle top, maybe in 2019. Okay, so if I just kind of take a guess and assume that this long-term moving average will continue to rise at roughly the same rate it's been moving for the last 4 years, then probably by 2020 it's going to be somewhere around between 6,500 and 7,000. Right now, we're just pretty stretched above this long-term mean. I'm going to say we may have to go sideways for the better part of maybe even at least the first half of 2018 before we can complete this move to 10,000. And 10,000 would, I'll just eyeball it, put us somewhere up around here. That would set up what I think would be a kind of a crash type event down into the 4-year cycle low in 2020. That would probably come back down to retest this long-term moving average, just like it did in 2016 and 2011. So based on this analysis, I think we're going to have to modify our trading strategies, anticipate probably a sideways consolidation, at least for the first half of this year, and adjust our trading strategies accordingly. So the FOMC meeting is on the 21st. Sometime between now and then, I'm going to take the loss on our AP position and assume that possibly the FOMC meeting is the trigger to push the market or start the market moving down into its daily cycle low. So I'll take a loss on the DIA aggressive portfolio position, and then wait until we get our next daily cycle low, which would presumably would come sometime around the beginning of April, I guess, assuming we run a normal duration of between 35 and 40 days, and then we'll try and re-enter that aggressive portfolio position, but I'll do it with an even longer duration, something that gets us past the election. I think the election is going to play an important part in this 4-year cycle. If the Republicans remain in control of both houses, then I think the 4-year cycle probably just continues into late 2019. And then we get our move down into the 4-year cycle low in late 2019 or 2020 as some kind of a crash event. If the Democrats take one of the houses, which I think the odds slightly favor that the Democrats are going to regain control of the House of Representatives, then that could potentially put an end to the business-friendly policies that Trump has put into place, and just make things more difficult. In that might be our top of our 4-year cycle, and then instead of a crash down into the 4-year cycle low at the very tail end, we may just get a long, slow slog back down to that bottom. That could run over, like a year to year and a half period. So for right now, like I said, we've just wasted too many weeks in this intermediate cycle. We're not even close yet to testing these all-time highs, and it seems to me that the problem mostly is just, when we look at those long-term charts, we're just stretched too far above the long-term mean to get another push higher just yet, unless we were going to, complete a parabolic move. And since we've already wasted 5 weeks of this, it just seems to me like the parabolic scenario is coming off the table. We shouldn't be wasting weeks going nowhere if the parabolic scenario was going to play out. So sometime next week before the FOMC meeting, I'm going to get out of the aggressive portfolio position, wait for a move down into a daily cycle low, and then re-enter that probably in the triple Q call options, and I'm going to buy more time. I want to have enough time to get us past the election, on the chance that we make the move to 10,000 before the election. But if we have to grind sideways into, let's say, July before the move starts, then I want to have plenty of time to get past that grinding phase, and I want to have enough time to get us past the election with still plenty of time left in our positions, just in case that we do get the top of this 4-year cycle on the midterm elections. And I may also decide to roll the Quest as well. We've got some pretty decent gains in those positions. On the chance that it takes well into 2019 to reach the goal at 10,000, then we're going to need we would need more time than just January of 2019. We might have to go out to January of 2020. So there's a very good chance I may also decide to roll the both Quest positions sometime between now and the FOMC meeting on Wednesday.